Hello, good morning. Once again, you're welcome to another module of this course, Financial Accounting. In this lesson, we're going to be looking at financial statement analysis. And under that, we're going to be looking at financial statements. We'll be looking at ratio analysis. We'll be looking at horizontal and vertical analysis. And we'll be looking at common size financial statements. So let's get right into it. What is financial statement analysis? Financial statement analysis is the process of evaluating a company's financial health and performance by examining its financial statements like the balance sheet, income statement, and cash flow statements to assess profitability, liquid solvency, and efficiency, ultimately aiding in informed decision making. But to have an understanding of financial statement analysis, we need to know what financial statements are, and I believe we've already treated this in previous modules. But just to recap, financial statements are records of a company's financial position and performance, including assets, liabilities, equity, investments, and cash flow. They are essential for understanding a company's financial health and performance. And we already know that the basic types of financial statements that we have are balance sheets, we have the income statement, we have the cash flow statement. So now we'll be looking at ratio analysis. What is ratio analysis? Ratio analysis is a crucial tool in financial statement analysis that allows stakeholders to evaluate a company's performance and financial health. By comparing various figures in the financial statements, analysts can derive meaningful ratios that provide insight into the different aspects of a company's operations: profitability, liquidity, efficiency, and solvency. There are three key types of ratios used in financial statement analysis, and they are, as we've mentioned, liquid ratio, profitability ratio, and solvency ratio. And we're going to look at all of these different types of ratios one by one. So starting with liquidity ratio, liquidity is a very critical part of a business. Liquidity is required for a business to meet its short-term obligations. Liquidity ratios are a measure of the ability of a company to pay off its short-term liabilities. Liquidity ratios determine how quickly a company can convert the assets and use them for meeting the dues that arise. The higher the ratio, the easier it is to clear debts and avoid defaulting on payments. And it's a very important criterion that creditors check before offering short-term loans to businesses. An organization that is unable to clear dues results in creating impact on the credit worthiness and also affects credit rating of the company. Now, there are various types of liquidity ratio, and they are current ratio or working capital ratio, quick ratio, also known as acid test ratio, cash ratio, also known as cash asset ratio, or absolute liquidity ratio, net working capital ratio. Now, what is the current ratio or working capital ratio? The current ratio is a measure of a company's ability to pay off the obligations within the next 12 months. This ratio is used by creditors to evaluate whether a company can be offered short-term debts. It also provides information about the company's operating cycle. It is popularly known as working capital ratio. Now, the next type of liquidity ratio is the cash ratio or absolute liquidity ratio. Cash ratio is a measure of a company's liquidity in which it is measured whether the company has the ability to clear off debt only using the liquid assets. It is used by creditors for determining the relative ease with which a company can clear short-term liabilities. It is calculated by dividing the cash and cash equivalents by current liabilities. Now we have the net working capital ratio. Remember that all of these are still under liquidity ratios. The net working capital ratio is used to determine whether a company has sufficient cash or funds to continue its operations. It is calculated by subtracting the current liabilities from the current assets. Next, we'll be looking at the second type of ratio analysis, profitability ratio. Profitability ratios are a class of financial metrics that are used to assess a business's ability to generate earnings relative to its revenue, operating costs, balance sheets, or shareholders' equity over time using data from a specific point in time. They are among the most popular metrics used in financial analysis. Profitability ratios assess a company's ability to earn profits from its sales or operations, balance sheet assets, or shareholders' equity. They indicate how efficiently a company generates profit and value for shareholders. Profitability ratios include margin ratios and return ratios. Higher ratios are often favorable than lower ratios, indicating success at converting revenue to profit. These ratios are used to assess a company's current performance compared to its last performance, the performance of other companies in its industry, or the industry average. Now let's look at solvency ratio. A solvency ratio is a key metric used to measure an enterprise's ability to meet its long-term debt obligations and is often used by prospective business lenders. A solvency ratio indicates whether a company's cash flow is sufficient to meet its long-term liabilities and thus is a measure of its financial health. An unfavorable ratio can indicate some likelihood that a company will default on its debt obligations. It examines the firm's ability to meet its long-term debt and obligations. The main solvency ratios include the debt to asset ratio, the interest coverage ratio, the equity ratio, and the debt to equity ratio. Solvency ratios are often used by prospective lenders when evaluating a company's creditworthiness, as well as by potential bond investors. So, another type we'll be looking at is horizontal and vertical analysis. Horizontal and vertical analysis are two types of analysis you can do that use simple mathematical formulas. Right? Ideally, 2 years of data is required to conduct these types of analysis because knowing your horizontal and vertical analysis for 1 year of business is useful, but you obtain greater insights by observing from trends over time. So let us look at each of these types, the horizontal and the vertical. Starting with the horizontal. The horizontal analysis, also known as trend analysis, looks at trends over time on various financial statements line items. A business will look at one period and compare it to another period. For example, a business may compare sales from their current year to sales from the prior year. The trending of items on these financial statements can give a business valuable information and overall performance and specific areas for improvement. It is most valuable to do horizontal analysis for information over multiple periods to see how change is occurring for each line item. If multiple periods are not used, it can be difficult to identify a trend. The year being used for comparison purposes is called the base year. The year of comparison for the horizontal analysis is analyzed for percent and dollar changes against the base year. Now, what is the vertical analysis? The vertical analysis shows a comparison of a line item within a statement to another line item within that same statement. For example, if a business may compare cash to total assets in the current year, it allows a business to see what percentage of cash makes up the total assets during the period. It is very different from the horizontal analysis that compares across years. Vertical analysis compares lines items within a statement in the current year. It can help a business to know how much of one item is contributing to the overall operations. For example, a business may want to know how much inventory contributes to total assets. They can then use this information to make business decisions such as preparing the budget, cutting costs, increasing revenue, and or investments in property, plant, and equipment. Now, the last type we'll be looking at is common size financial statement. And a common size financial statement displays items as a percentage of common base figure, total sales revenue, for example. This type of financial statement allows for easy analysis between companies or between periods for the same company. However, if the company uses different accounting methods, any comparison may not be accurate. While most firms do not report their statements in common size format, it is beneficial for analysis to do so to compare two or more companies of differing size or different sectors. Common size financial statements reduce all figures to a comparable figure, such as percentage of sales or assets. Thank you for watching this video. In the next module, we'll be looking at financial fraud. Bye for now.